We've got markets at record highs heading into another U.S. trade deadline. We've got a lot of positive momentum in equities, but is it going to be tested? Brad Simpson, Chief Wealth Strategist, TD Wealth, joins us now with more. Brad, great to have you here.
Greg, it's great to be here.
You bought some pictures for us, some charts to help tell the story, and as we laid it out, looking at markets pushing on a daily basis, it feels like now, into new highs. We still got a lot to worry about. Are markets decoupled from the economic reality?
Well, the markets might ultimately be decoupled from reality. I guess, right off the bat, I know usually we have some pleasantries and then we go into a chart, but I think this really is a great way to start this in about a week or so, we're going to be coming to the deadline for tariffs. And of course, that was supposed to be one of the big risks that are out there. And what we're looking at here is the direction of the S&P 500. The arrow that you see going down, it's actually inverted. So what we're saying there is trade policy risk and tariff risk is actually headed up. And if some of the concern out there is about tariffs and somehow on that August 1st, because we've sort of seen along the way some big drops. This is a market that's not terribly afraid or worried about tariffs at this point. Now, there is some good reasons for that, I think, right out of the gate. Mansi Desai, who's a senior analyst on my team, published a paper called Made in the USA about, I think, 10 days ago. You can find it on my LinkedIn. And it's a fantastic article where, she breaks down U.S. trade policy, but really makes, I think, a really convincing case that the U.S. underestimated the strength of the folks they were going to be negotiating with, in particular in China, which there's a long ways to go to be able to negotiate this. But she makes, I think, a really brilliant point to say that, that America didn't hold or doesn't hold the cards in the big stick that they thought in these negotiations. And so what we're seeing, as we saw, the agreements of 15% with Japan last night, that there's a better tone around trade now, and that better trade ultimately is I think them coming to the conclusion, they've got a strong negotiating position, but they didn't have the negotiating position that they thought they did, and so we right now, and what we've had since our last quarter said, look, we think it's going to be somewhere between 15 and 20%. That's our 45% base case scenario for tariffs. That's certainly where they're starting to come in. And I think that's, out of the gate, I think that's what we're looking at. Now, to the second part of that question, and your comments on the way in is, I kind of laughed to myself in your introduction is, when your part of your introduction is talking about the strength of meme stocks, that's usually, we better get our chief strategist out.
Right? What's going on?
What's going on, right? And so I think a little bit is that, I want to draw a picture for you and folks who are in today and kind of go, okay, so let's look at this picture, and then what conclusions would you come to from it, right? So if we start out of the gate right now, S&P 500, we know that there's a V-shaped recovery that we've seen, a rally that we've seen, again, has been focused on big name and tech and tech companies, and now sitting at highs that we've seen of concentration of these big name tech stocks of roughly around 34% in the S&P 500. So let's call that we've eclipsed the peak of what we saw for concentration back in 1999. And of course, we know a little bit what happened from there. But if you look at the size of this, let's call it somewhere between 18 and 20 trillion dollars in market cap. That means one subsector of the S&P 500 now is larger than any other nation's index. Right? Like just stop, let that soak in a little bit. So there's point one. Let's set that in a little bit, right? And then you go, okay, when we're publishing our portfolio strategy quarterly for next quarter coming up next week, okay? And it's called Still Here. And why did we call it Still Here? Is this idea of a year and a half ago we introduced this concept of gray rhino, right? And a gray rhino, of course, is risks that we know that are there, but you can see them coming, but you do nothing about, right? So one, we made the argument was this idea of deglobalization. And this is something, and this is a little bit what we're managing through right now. The other one was AI. What is this going to mean? The positives and the negatives to them. And this movement we're seeing is, if you want to look at what's making tech things move, it always comes down to, well, it's AI, well, it's AI, well, it's AI. And you've got to be careful of monocausal reasons when you underline those. The third one we underlined is war. And of course, we've got 3 pretty actively engaged theaters of war going on right now. Now, interestingly, these risks, the market has said, well, they're off to the side right now, and I think they are cooler than what they were. But we got to remember, like they're kind of out there still, right? So we look at those and you go, the VIX is at 16 right now. Long-dated puts, okay? If I wanted to go and I wanted to buy insurance on the protection of my portfolio, are dirt cheap right now. So which means saying that the market is saying that I don't need to worry about it. I don't need to think of any way of hedging
part of that
out.
story? I know you have a picture about like spreads right now being historic.
Yeah,
so you're talking about relatively risk-free debt compared to...
Yeah, so let's look at, I brought a chart along for spreads. Let's look at this. So what we're looking at here is, so this is in fixed income markets, and this is looking at the spreads between corporates, from quality corporates over to the high yield stuff, and looking at it over treasuries. Now, the one bang in the middle there is that the spread of corps over a 10-year treasury is at the 0 percentile. So if you see every one of those little black diamonds there, all at the bottom of every one of those bars, what that says is that when you're looking at the spreads for corporate debt right now, from quality to junk, is at the absolute bottom, meaning it's the non-government side of the fixed income market saying there's no risk, right? Like, so we kind of checked that one off. Okay, I brought another slide, and let's take a look at this. This one we're looking at factor exposure. So often, when we're talking that when you're allocating a portfolio, asset allocation isn't enough. You also want to think about factor exposure. Factors like the DNA of what makes an equity come. So if we can put up the factor chart I brought, and take a look at this. What we can see is that no, not that
growth
one.
And higher risk, growth.
No,
and
no, we're going to come to that one. That's the there we go. Okay, so let's look at this. This is looking at first half of 2024 performance of equity markets, but through a factor lens. So the DNA of what makes the equity market roll. What's driving it? Well, momentum up 12%, growth up 13%. The rest, low volatility, value, small cap, all in the negative. So the one fundamental, it's like inside of your body. If you had one driver making yourself go, that's the one that's making it go. Okay, let's look at the next one. It's the last one, and again, the idea here is that, let's step back and just look at the world through a different lens and just think about this a little. So what we're looking at here is the S&P 500 move, which is the black line, the Renaissance IPO index. Okay, so what we're thinking about there is just the most speculative part of the market that you want to consider, and money's plowing into there. The top green one there is the SPAC index. Okay, the SPAC index is just the ability to go out and accumulate and flow that are going to go into SPACs. How many people have been talking SPACs here on this show over the last couple of years?
Not been talking SPACs very much at all,
right? You're even SPACs. Okay, so these were absolutely dead, left at the side of the road, and where we are looking at today is all of a sudden this is back in vogue again. And my point with all of this is you kind of go one by the other, and again, to bring it up, we're also talking about meme stocks once again. There's lots of money in the system. There's really, it's really quiet with folks at work moving assets right now. In the equity market, that if you're moving into the second half, that what we saw in the first half, and we wrote a little bit about this, is that once we went after Liberation Day, retail or wealth clients really started to move into the back end of these tech names, and managers who've been underperforming the benchmark for the last couple of years start looking down and say, wait a minute, I might underperform again this year as well. So they've all started to move into this. So the last one in my picture of this is when the Joes and the pros both are plowing into something, and these are all the steps. I'm not trying to lead us to an alarming ending here, but what I do want to do is a little bit is to say that, like, let's think about this a little bit, and if you had a chance to say, for my speculative money, this is what this market is. For my money that I'm investing based on my wealth plan, where I want to grow and I want to protect, and I'm thinking about funding things and my liability and how the things that down the road I want to fund, I think this is a place where you want to stop a little bit and make sure that there's a strong barrier between these two that says that how I'm going to allocate over here, where I'm going to speculate here, but know that you know, when we turn the tap back on a little bit, and we can talk about one of the things that I think might be the thing that cracked this thing a little, that we don't get caught up in this, and I think, you know, I think we're seeing some of that right now.
Okay, we got about a minute, so you just tease people with what could crack it. Give us a little taste.
Well, so I mean, I think the long story short is that in our publication next week, what we do is we do a deep dive into the U.S. labor market. And why is that important, right? We know that ultimately the U.S. economy is driven by the consumer. The consumer feels good when they have their job. When we look at the labor market, it's very, very good in the United States. However, we have seen the last non-3 farm payrolls come out, and they were starting to turn over. And when we're seeing adjustments to those non-farm payrolls, we see them adjusted, and we see them headed downwards. When we take the consumer part of that labor part and look at the health of the consumer, what we can see in active data now, what we can see is both in restaurants and entertainment, we start to see those starting to roll over. When we split the high-income earner, low-income earners threw in the towel about 18 months ago. High-income earners are starting to really slow as well. I think, and so what we want to go is to say that you know, you and I've talked a lot about labor and consumer here on these before, but I think in this one for us is that it's not that they're saying the end is nigh, but there is something in this labor market that is telling us that the growth in the United States is slowing, and it's not an inevitable recession. But we think that these are one of the things that could provide a crack as we move when markets turn back up again, like when volumes turn back on and we enter into September.